Hello, everybody. Welcome to Zoe's Treasures. My name's Tracy. Hello, I love discounts. And as always, I'm here with my husband, Noel. He's in the background giving me a headache and doing our graphics. So if you've been to any of our shows, you know the drill. He sits back there and tries to tell me what to do while I sit here and talk to you. That's the way we do it here. The Thrifted Clover, thank you so much. Yeah, it is a pretty cool intro. My husband does all of our graphics for us, so thank you for saying that. Reclaim Vintage, hello, hello. So tonight is the final night. Are those previews behind you? They're not. So I love discounts. These are not bougie for a buck. These are the reverse auction. So everything you see behind me will be on sale tomorrow at 8 a.m. in our reverse auction. But I do have a bougie for a buck show coming up in May, and it's going to be items very similar to this. So we have some swung vases, some fairy lamps, items of this caliber in the bougie for a buck that's coming up also. So tomorrow morning is reverse auction. So as I'm talking, if you want to take a look and zoom in, I also have them all pre-listed for the show tomorrow morning. So you can get in there and take a look and, see all the details. So, I don't get permanently. Yeah, I got to keep them around. All right, so tonight is the very, very last tax ask a CPA any tax question you want. I may not be able to answer it. I'm going to give it a shot, though. So we're just doing this last one. Most of you hopefully filed your taxes, but if you filed an extension and you're still working on it, or maybe you've just been through the tax season and you're just kind of like, hey, I'm curious about this. My accountant told me this. Feel free to ask. If not, while I'm waiting to see if there's questions, I have a couple of very quick hit type topics that we can talk about. And with that, we'll just kind of see where it goes. So no real plans on what to talk about besides tax. So if you have anything on your mind, throw it out there. I am going to start a giveaway. I have a few of those. They are for the CEO affirmation cards. So this is our affirmation cards. There are 52 different ones. And so we just randomly pick one and you get one of these. You're getting money back, looking to get more before filing. Well, that's great. Awesome, Kate. I use Quicken. What categories should I use for jewelry? So what categories? What I would suggest on categories, take a look at a Schedule C. So you can go to www.irs.gov, look at a Schedule C. And I would match your categories as close to that as possible. It just makes it simpler. And the categories there pretty much cover almost any type of business. And then what I would do, start with that. Then if there's more specifics you want to track, like if you have different types of jewelry, maybe you want more information on earrings versus necklaces or something of that sort, then you can put additional categories based on the information that you really want to track and data that you want to pull out of your bookkeeping. But that's what I would suggest, is starting with what's on your Schedule C and then adding in categories as you feel the need to track your information. Oh, we're looking to pull up a Schedule C. Let's see if we can pull it up for you real quick. Oh, you got it? Okay, so pull it up. So when I say the categories that you should use, under expenses there, so I would set up your chart of accounts. Are your categories similar to this? I would do an advertising, vehicle expense. You could skip depletion. You're probably not going to need that. Depreciation, you could skip that. Insurance, legal and professional services. So this is what I would start with. Can you scroll over to the other side? Supplies would be the next one. Like office expense, supplies. So travel, taxes, or licenses. So any of these that would apply to you is what I would use. And then again, drill down a little bit further, add more as needed for you to make good business decisions from. You are very welcome. Thank you so much for asking the questions. It's so much better when you guys ask questions. If not, I'm just going to ramble. I'm just going to talk. So, we have been talking a lot about in the shows recently. If you guys don't know me, I do a business and tax show every Friday morning at 7 a.m. We go for about 2.5 hours where we cover a business topic and then a tax topic. And we've been talking a lot about the difference between profit and cash flow. What's expendable when traveling for a whatnot meetup? Very good question. I love discounts. So if you are traveling for any type of business purposes, you can deduct, if you're flying, your airfare, your hotel, if you're driving, your mileage, Meals are at 50% of your meals, or if you don't want to keep all your meal receipts and do 50% of your meals, there is IRS per diems. They're usually a little bit lower than what you're spending on your meals, but that's a way if you're like, I don't want to deal with receipts, I'll just take what the IRS gives me for meals each day. You can do that. I'm trying to think anything else that would be a normal business expense as you travel. So in a weird case, here's a weird one. If you're traveling and you're flying and they lost your luggage, any incidentals you would have to buy in order to get by for a day or two, that would be business deductible because you are there for business purposes. If you tips, parking, so if you're tipping the bellhop or you always tip like the waiter, but maybe the valet, those type of tips, those are all business deductions for you. That's pretty much off the top of my head what I can think of. So Ubers, yep, absolutely. If you're doing Ubers, car rental, all of that would be deductible. So anything surrounding that trip that is a business purpose. Now, if you're on a business trip and one day you decide to go to a museum for fun or go to the zoo or do something for fun, it's still a business trip. You just don't deduct the Uber to the zoo, right? So you could just be reasonable about it. If you're doing something personal, just don't deduct the personal part of it. But there's nothing wrong with the IRS isn't going to look bad on you if the main trip is business and you take a few hours or a day to go do something fun. That's still fine, as long as the main purpose is business. So we have been talking a lot lately about how your bank account lies to you. Did you know that? Did you know your bank account lies to you? So the reason why it lies to you is because the money you have in there reflects cash flow. It doesn't actually reflect your profit. If you go on a cruise and do a demonstration of your jewelry aboard, no, you cannot. Not unless the cruise itself is a professional association like Designated Cruise, or it's a type of a business cruise that's made for vendors to come together, like a vendor fair. Rookster, you got that giveaway. Congratulations. So just going on the cruise and setting up like a booth on the cruise doesn't make it business. Association. So being a CPA, I'm part of the AICPA, American Institute of Certified Accountants, along with the states that I am licensed with. Sometimes associations like that will do cruises or do events. Those are more business deductible because you're on the cruise, but you're also sitting in like educational classes. It's not all about the cruise. You'll hear a lot of people talk about on Whatnot, and in other places, Facebook and other places, that, go on vacation and it's totally deductible. Take your kids, take your family. And it's such a misconception because it's such an easy way for people to try to manipulate the system that the IRS really does look at it. Not that you're going to get audited if you do. It's just something to make sure you're being really like upfront and honest about. If you go on a business trip and you take your spouse, if your spouse is an active part of your business, then the expenses for both you and your spouse are deductible. If your spouse is not an active part of your business, if it was just me, Tracy, doing this, and my husband had nothing to do with this business, and we are going to the Whatnot Seller Summit next weekend, I couldn't deduct his airfare and stuff if he had nothing to do with the business. But because he's part of that, I can deduct that for him. However, yes, you're going to say something?
See, Miss Kate, I'm trying to get fired, but she wouldn't do it.
Now, going to the Seller Summit, if I were to take my 15-year-old with us, nothing for her. Her airfare, she wouldn't be in a hotel room by herself, so the hotel's still covered because we're in it. But her airfare, half of her meals, none of that would be deductible for her because she has no real part in the business yet. Or in that part of the business where it would be ordinary and necessary for her to go. Those are two key words. I've said them a million times and I'll continue to say them till forever probably. When you're thinking about what can I deduct, what's deductible on my tax return, the IRS says ordinary and necessary for your business. So if the expenses are ordinary and necessary in that line of work and they make sense for your business, they're part of an expense that supports your administrative function, storage of inventory, or production of revenue, then it's deductible. So think about that, and that looks very different for different businesses. Think about a race car driver who does this as his profession. An engine, a race car engine, and tires and automobile parts are ordinary and necessary in his business. Is that, are automobile parts ordinary and necessary if you're selling jewelry on whatnot? No. So you got to kind of look at it like that. And this is why you hear a lot of people saying, oh, well, my accountant said I can deduct it. Yeah, well, maybe that's ordinary and necessary for a clothing business, but not for a vintage decor business. Handmade cost of goods giveaway, add to cost of goods, or advertising. So if you made it to begin with and it was part of your cost of goods, then you would pull, or part of your inventory. If you made it and it was part of your inventory, you would pull it out of inventory and stick it into cost of goods. If you made it specifically for advertising, I would put it in advertising. It keeps it cleaner that way. And that's kind of one of the ones that you could probably do. You could probably still just go straight to advertising and not do cost of goods, but I like to keep it clean. If I'm making something for inventory and it's sitting in my inventory and I'm doing a show and I'm like, oh, I think I'm going to pull this out of my inventory, I would record it that way just because it's really true to what happened, versus if I know I have a raid train coming up and I'm making something special just for the giveaway, that's purely advertising. So I hope that helps. How many of you have already filed your taxes? Throw a little emoji in if you're going to celebrate because you are done with taxes for the year. We have a black candle, camel toe, amber. All right, so we got a lot of you. Endless treasures, a lot of you are done. Congratulations. I bet it feels good. It's a weight lifted off of our shoulders every year, right? That we're done with it for a while. So now that our taxes are done, what now? What do we do, right? How about go pull that tax return back out. I know you don't want to see it again. You closed it on your computer. You saved it in a file. You're waiting on your return. Awesome. And you scheduled your estimated. Good for you. You are on top of it. Though that's the type of stuff I love to hear. So for those of you who are like, okay, I'm done. Open that file back up really quick. Not right this second, but when you get a chance, when you're sitting over your coffee on Sunday morning, look at that inventory number that you had on your Schedule C. Write that inventory down because that inventory number is your beginning inventory for 2026. So you should have had your ending inventory on your 2025 return. You're going to need that ending number because that's your beginning number for this year. So that's an important number you're going to want to just keep written down and know for your records and to move forward in your bookkeeping. First time you have ever done that. Well, congratulations. You are like on fire, on top of it. The other thing is, most of you, I'm sure, if you didn't, I would love to know why you didn't, claimed a mileage deduction. So while you have that tax return open, take a look at whatever you put down as your ending odometer reading, because the IRS would have asked for that. So take that ending odometer reading and make sure that your log for 2026 reflects the right number. So 2 will be harder? No, I think 2 will the first year is always the hardest because the first year doing taxes for a business, you have to make a lot of decisions about the way you're accounting for different things. So year 2 is just kind of a repeat. So write down your inventory number, write down your ending odometer. Both of these are on your Schedule C. So get those numbers out and you're going to need them for your 2026 books. Hopefully you should be using them already in your bookkeeping. The other number that I really want you guys to look at, and let's see, let me go back. Who was it? Amber said that, was it Amber? Hold on. Was it Amber that said, no, there isn't. That you already, no, endless treasures, already scheduled estimated taxes. So in the realm of estimated taxes, the other piece of information that you're going to want to grab from that tax return is there is a line on there that says total tax liability. You need to know that number in order to figure out if you owe estimated taxes this year. So there's 3 numbers from that tax return that are really vital to you in 2026 and moving forward. So before you file it away forever and forget about it, pull it out and make sure you're writing those 3 numbers down because those are really important. Will I need inventory number if I end up using the standard deduction? Yes. So the standard deduction has nothing at all to do with your Schedule C. Your standard deduction, it has to do with your personal tax return. So when we file a personal tax return, a Form 1040, there's certain variations of 1040, but basically it's 1040. When you file that, you can either take a standard deduction or an itemized deduction. So the standard deduction means the IRS says, okay, if you're a single person, we're going to allow you X number of dollars because we know it costs something to live in this world, right? So it's like, I don't know off the top of my head, 13, 14,000 right now. If you're married, it's a little bit higher. If you're head of household, it's a different number. If you're widowed, it's a different number. So there is a standard deduction. The IRS just says, look, we're going to allow you to take off so much of your taxable income because we know it cost you just to survive. That's a standard deduction. Well, a lot of times, if you are paying other expenses such as mortgage interest, real estate taxes, state taxes, charitable deductions, there's quite a few others that would go on what's called the Schedule A. That is your itemized deductions. If your itemized deductions are higher than your standard deduction, so let's just say your standard deduction is $15,000, but by the time you add in your mortgage interest, your real estate taxes, your state tax, your sales tax, all of these other things, and they exceed that $15,000, if those come to $20,000, then you can take the larger number. So you can either take your standard or the itemized. It usually only works out that itemized is better when you have those major things I just talked about. That's also where if you have major medical expenses, it goes on your itemized deductions. It's where you take your mileage for your medical and your charitable expenses. So if your Schedule A itemized is greater than your standard deduction allowed by the IRS, that's when you take your itemized. So it has really nothing at all to do with your inventory because your inventory is on a Schedule C. So completely different form that it goes on. Hopefully that answered it. If you have more questions about it, please ask because I'm happy to keep trying to talk about it and explain it. Some of the new stuff that came out this year, there was a really, thank you so much. There's a really cool deduction that I hope you guys didn't miss. If you bought an American-made vehicle last year, a new vehicle, where did I go? No, he just likes to make it go black every now and then. If you bought an American-made vehicle, a brand new vehicle last year, there is a deduction for the interest you would have paid on your vehicle loan. So if you financed it, if you didn't go down and pay cash for your brand new vehicle and you had to finance it, more likely than not, you probably had some type of an interest rate somewhere between 5 and 15%. That this year, for the first time ever in history, is deductible on your tax return. Now, there's limits. There's income limits where, if you make so much money, you don't qualify, but they're pretty generous limits. This is one. Yes, I know, Amber. A Monster Mama, you got that giveaway. Congratulations. I actually have, my truck that I bought in 2020, we actually had 0 interest. They just don't have that anymore. Let me get another giveaway going. So this is the first time they have ever done this type of a deduction. And these are the kinds that I really, really like because this deduction on your automobile interest is specifically aimed at the middle class. And there are very few deductions that are specifically aimed at the middle class. So this was really a great one that got put into the Big Beautiful Bill Act back in July of last year, where a lot of your deductions, a lot of the things we see are refundable credits, and those go towards lower income. So usually poverty level and below. Those are things like your earned income credit. Child tax credit is available to everybody, but it phases out as you make more money. Some of your college, some of the credits for college expenses are refundable, and those are really aimed at poverty level and below incomes. Then the other type of deductions are usually higher level deductions for if you're making over like 300,000 or 400,000. So there's very few for the middle class, and this was just a really good one that was really aimed at the middle class Americans that don't normally get deductions. So that's just kind of a little side note on some tax facts there. Let's see, moving forward. Good evening, Custom Woodburning. I cannot talk tonight. I am like stumbling over my words. I have a question for everybody here. if you've done your taxes or if you're still doing your taxes, what was your pain points? Did you have any points during the tax process that you were like, oh, this is really difficult, I don't understand this? Did you have any pain points at all during your tax process? Hello, crystals. No pain points. That is amazing. I'm so glad to hear that. If you did, throw it in there. We can just talk about pain points. It's a good thing because I'm sure if you experienced a frustration with something, other people experience that frustration. What I can say, anything that you experience frustration, if it wasn't due to the IRS just being difficult to like read and understand sometimes, it's probably due to our lack of record keeping. Oh, you only track mileage for that. Now that's a really good one, Looking Glass Treasure. And that's a really good point. A lot of people, we have a lot of talk about tracking our business mileage. So we do really good on that, but we don't realize that we also have to put our beginning odometer and our ending odometer so that we can calculate what our personal mileage was. Where to put what not pay out fees in TurboTax. So Cream City Rollers, usually if you can't figure out if there's not a good category on the Schedule C, that's what falls under, I think it's line 21 or 28. It's the miscellaneous line. And it allows you to type in your own title and put in whatever the expense is that you're deducting. I use it all the time. I usually have probably at least 10 different things under miscellaneous, and you have to list them out. So I'll put things like, it may be fees, possibly like subscriptions. That was one that goes underneath there. So there's just different things. If it doesn't fit in any predetermined category on your Schedule C, put everything under miscellaneous. It's okay. Going back to the mileage, they had me put it in something else, but next year I will know. Yeah. And a lot of times, look, there's certain lines on that Schedule C that are vital to be like, get it just right. There's other lines like supplies that are kind of loosey-goosey. It's kind of like, as long as you're halfway right with the classification, nobody really cares. The IRS is not going to come knocking on your door and say, did you classify that pen as a supply or as a miscellaneous expense? Like, they don't really care about that. So a lot of them are very lenient in how you categorize it, because really at the end of the day, what they want to know is what your net profit is, so that is what you pay tax on. That's what's really important. Now, there are some lines on that Schedule C that we want to be careful with. Commissions, contract labor, payroll, anything along those lines that would indicate a reason why you as a employer would have to do a 1099. Those are the ones that I shy away from unless I am actually issuing 1099s, because those are triggers for the IRS to say, hey, they put expense here under commissions. Did they pay a 1099? Did they issue one to somebody? She said she doesn't like their Schedule C. It's not the same. All the Schedule Cs are the same. There's only one Schedule C. I'm not sure what you're talking about. So all Schedule Cs are the same. There's only one way. There's only one form. When you're using any of the programs, TurboTax, Free Tax, a Monster Mom, it's your lucky night. Congratulations. Thanks for being here.
Congratulations.
I like to use Free Tax USA because it's free. And they perfectly fine for a sole proprietor. None of the Schedule Cs, like what you're typing on the screen, all look different. But they all ultimately, if you were to go and print that tax return, that Schedule C is going to look exactly like the Schedule C we just had up on the screen a few minutes ago. They have to. It has to conform to the IRS way. The IRS says it can only look one way. The reason for it is that a lot of them, it used to be when we would mail in returns or fed through machines. Now they're electronically processed. So if it doesn't fit in the certain parameters and the boxes aren't laid out exactly right, it can't be read. So it has to look the exact same. So when we're entering it, when we're sitting there on TurboTax or any of these tax software and we're putting it in, they're going to ask us one question at a time. We might not actually see the form, but in the background, they're putting it in the proper form. Maybe it's a form they have you fill out, but it didn't look like yours. Correct. Yeah, now if you were to actually print your schedule, like if you pull up your PDF of your tax return, it should look just like that. that Schedule C. I pulled the Schedule C right from the IRS website. I also had inventory I owned was hard to know the cost. Yes, so valuing your inventory, particularly in the first year, is very difficult because just accounting for inventory is probably one of the more trickier parts of accounting for resale. And so then also knowing how to put it on your tax return. So a couple different things happening when you value inventory. If you buy it, that's easy. It's what you paid for it. So the value of inventory is always what you paid plus any shipping and taxes. So when you buy it on Whatnot, you got to pay to have it shipped to you and the taxes. All of that, and any improvements you may make to that inventory in order to sell it. And I always like to give the example, if you're a clothing seller and you buy a shirt and it has a little hole on the seam and you pay a seamstress to fix it, that's part of your cost of goods and fixing that. That's so anything you paid for it. Workstar, I see you're coming. I'll get right to it. The next thing is, if you've already owned it, if you're just pulling stuff out of your closet or off your wall or out of your storage just because you don't use it anymore, it's up to you to try to remember to the best of your ability what you paid for it. If you absolutely can't remember, then it's recommended to go the most conservative route and value it at thrift store value. So whatever your local Goodwill would charge for that vase or that pair of jeans, that's what you should put as the value, because that's the most conservative way to figure out a value. Then the third way is when somebody gives you something, then there's zero value. So if your sister comes over and she's like, hey, I don't like this vase anymore, you can sell it, I know that's what you do, and just says, here, have it, then that value, your cost of goods is zero in that item. The only other way really that we get items is through like an inheritance. So through a will or an estate of a loved one. And then that's valued at it's what's called a step-up value. So it's valued at the date that you received it, whatever the average value would be for an arm's length transaction at the date you got it. I decided I want to become a seller. Should I get my odometer reading now or wait until I actually start selling? You get it the minute you start using your vehicle for business purposes. So I would assume that's actually before you're selling, because you're probably sourcing before you sell. So get it the minute that you start using your vehicle for business purposes. And if you're just coming in now, you don't get it. I don't get it. Okay, don't get what? Tell me what you don't get and I'll help you. If you're just coming in, there's a couple of pieces of information I was going over that you should absolutely get right now before you go any further in this tax year. We're only 4.5 months into the tax year. So there's 3 vital pieces of information you need to, like all the taxes. Okay, we'll talk about it. 3 vital pieces of information you need to go and look on your tax return and get. The first one is your odometer reading from your tax return, because your ending odometer reading from last year will be the beginning one for this year. It's something you need to file your return. The second one is your ending inventory number. You're going to need to get that. And the third one is the line that is called tax liability. You need to know that in order to figure out if you have to pay estimated taxes. It is overwhelming, but walk in love. Let's make it less overwhelming. This is what we can do to make it less overwhelming. The main thing, the biggest thing to do is don't worry about taxes at the end of the year. Okay, let's just forget they exist for a moment. So first of all, that doesn't become an issue, right? No taxes. If you are doing what you should be doing, let's see who got that and we'll talk about it. Good. See, that's where we're getting. Ellen, you got that giveaway. Congratulations.
Congratulations.
So the biggest way to make taxes less overwhelming is to do what you should be doing as a business owner, regardless of taxes, which is recording your inventory. You are very welcome. Thank you for being here. Recording your inventory, recording all of your revenue, recording all of your expenses, tracking your inventory, keeping your mileage. So keep some type of a log, written, electronic. It's okay. It doesn't matter. And do that consistently. If you're doing that, taxes become a breeze. Yeah. So there you go. So next year, taxes should be so much easier. And there's a few basic concepts that we talk about in understanding taxes. So when we're doing all of this recording, week after week, we're tracking our revenue, we're tracking our expenses, we're tracking our inventory. Thank you so much, Walk in Love. When we're doing that week after week, we're doing that because we own a business, and as responsible business owners, we keep up with our accounting. Why? because that's our data. That's our history. That's what we use to make decisions moving forward, right? Is all that data. So we're doing it as responsible business owners. Thank you. And then after we do that all year long, just because we're good business owners, we get to tax time. We already have everything we need for taxes. Now, there's some things on taxes that may not be deductible, and there's some special rules, but we can deal with that. We can handle it, because the important thing is that you've gathered all that information consistently in a systematic way throughout the year. It will make tax season so much easier for you. If you guys have want to look at any of these, we do have all of our shows on YouTube. So we multicast. We're the same name on YouTube. So this is our last Friday night doing this. I will talk about that, Cream City Rollers. So this is our last Friday night because we're at the end of tax season, but I still have Friday mornings, every Friday morning from 7 to 9, about 9:30, I'm on, and you can always, Eastern time, and you can always come and ask questions then. I'm also available by DM. Feel free at any time, you can DM me questions, and then we do have everything on YouTube. So if you ever want to go back and watch any of these, and I'm going to be replacing this show, we're probably going to talk about some personal finance and go into some handmade accounting stuff as we move through the rest of the year. Thank you. I'm so glad you bookmarked. Thank you so much. All right. So if a product doesn't sell, so if you bought something for your inventory, when you buy it for your inventory, I'm going to read this question really quick. The first 2 months of this year, I didn't keep track of anything, but last month I did start. How can I fix? Mama, go back to the first 2 months, look at your bank statements. Do it now while it's still kind of fresh. At 4.5 months, it's going to be fresher than it is when you're in month 12. Go back at your bank statements, your credit card statements, anything you would have used to pay expenses. Gather as much information as you can. Use those expenses to recreate a mileage log. So every time you got a post office receipt, you know you had to drive to the post office. Save receipts, yes. And then pull down, go to Whatnot and any other sites that you're on and pull down your monthly statements from there. So recreate now as much as you possibly can. Are you going to get 100% of everything? No, you're going to miss some stuff, but do the best you can. I have the PDFs and have been using YouTube. Oh, thank you so much. I'm so glad, Tabitha, that you're learning stuff. You guys, we're going to go back really quick and talk about what if the product didn't sell. I'm not ignoring that question, Cream City Rollers. I'm getting there. I'm just slow, but I'm getting there. I do have in the bin, you guys, I do have PDFs for sale. I flash saled a couple of things in there. I think the PDFs are on flash sale. So if you're interested, they're there. You're never obligated to buy anything here, but we do have a library that I add to consistently. We have like 29 PDFs in there right now. They're also for sale individually. We also have a separate library of all the books that we have out there. So that's a whole nother library where you get access to any book that I write this year. And one of the biggest books that we have is this one. If you are a reseller and you are not coming to my Monday night shows, I am teaching reseller accounting on Monday nights. And we are going through 12 weeks of reseller accounting. Those are also on YouTube if you just want to learn accounting on your own. But every Monday night, we talk about one topic, and then we build on it each week. So that's just something else that we're doing that's out there if you're interested. And it's free to come to the Monday night classes, free to watch it on YouTube. And the book is just there if that's the way you learn best. It's available, but not necessary. So let's go back to products that didn't sell. When you buy inventory, you're trading cash for an inventory item. It's still an asset. It's something you own. It's not an expense. So when I go to the antique store, oh, let's see who's going to win that. Cream City Rollers, you got that giveaway. Congratulations. So when I go to the antique store to buy some inventory, when I go sourcing, I'm just trading my cash for another type of asset, okay? So no expense happening at that moment, just an asset sitting on my shelf, something I own. Then when I sell it, it becomes an expense. When I sell it, it becomes cost of goods sold. This is probably a pet peeve of mine because I'm a CPA. Inventory and cost of goods sold are not the same thing. You will hear people consistently just call it cost of goods sold. They're two different things. Inventory is what you own. That's everything you bought. That's what's sitting on your shelves. That's what's listed in your shows. Cost of goods is when that inventory sells. Then it becomes cost of goods, which is an expense. So Cream City rollers, anything that didn't sell that's still sitting on your shelf is just sitting on your shelf. It's an asset. That's future revenue. That's something you're going to have in the future. It's not an expense, and it doesn't really even go on your tax return. All right, hopefully that was good. Hello, Aaron. Thank you for joining us. Do you have any tax questions, Aaron? So some of the stuff is what if it never sells? It's never an expense. Go ahead. You want to say something?
Aaron, the boss has spoken. So what you saw at the end, the boss has spoken.
I have no idea what he's talking about, but we're going with it. So if it never sells, so let's just take this. I bought something. I thought it was the coolest thing in the world and my customers would love it. I've put it in 15 million shows and nobody loves it. So it's still sitting on my shelf in my inventory room. And finally, I get tired of showing it. And I say, you know what? I'm going to donate it to Goodwill. I'm getting rid of this thing because obviously my customers don't like it. Well, at that point, it's sitting in our inventory, right? Now that we're getting rid of it, we treat it in accounting purposes as if it's a sale. We pull it out of inventory and we record it in our cost of goods sold. Okay, so we record it in our cost of goods sold. Even though we don't have any revenue for it, we pull it out of inventory. We can't record it in our expense. So it can go into cost of goods sold, or you can have obsolete inventory. You can have actually a category that's called obsolete inventory, and we record it there. That's inventory we just couldn't sell. And that's how you get an expense for it eventually when you get rid of it. So you get credit then for the amount that you paid. I have done a pair of shoulder pads that have been living this life for a year. Yes. We all have those things that we buy are thinking going to be the next best item, and we end up we just wrote it off. We can't do anything for it. Is it possible then a loss? Well, it's not necessarily a loss. It just is an expense, and the expense is the exact same amount you paid for it. So you do get to take credit for it eventually if you donate it, if you get rid of it. Now, you can't take it as an expense and put it on your Schedule A as a charitable contribution. That's called double dipping in the IRS eyes. So for business purposes, here's the other misconception that you will hear. Oh, just donate it. It's a charitable expense, or it's a charitable write-off. No, it's not. The Schedule C, there is no charitable deduction on your Schedule C, on your business part of your tax return. Charitable deductions are for your personal tax return. And if it was a business asset, it was part of your inventory, you get to take the expense for it on your Schedule C, but you do not get to put it on your Schedule A. Now, if there is no expense associated with it, if it was something that was given to you, you didn't pay anything for it. Like, we'll go back to my example before. Your sister gives you this vase. It's the ugliest vase in the world. You try to sell it and you're like, girl, this thing is ugly. Nobody's going to buy it. I'm going to give it to Goodwill. Because you never paid for it, then you can just say, okay, this is personal. I can take a charitable donation for that, or contribution for that. So you really have to look at was it a business asset or not? But there is no such thing as a charitable deduction for business. And you'll hear this a lot. You'll hear a lot of people say, oh, if it doesn't sell, just donate it. You can write it off. It's not a write-off on charity. That makes sense? Okay, good. There's a lot of misconceptions out there, and I have to bite my tongue quite frequently, because what happens, and I've said this before in my shows, what happens is somebody will go and talk to their tax person or their accountant, and if it's free and does sell, your cost of goods is zero. If you didn't pay anything for it, your cost of goods is zero. It's all profit to you. So that's kind of the best kind. Like if somebody gives you a bunch of free stuff that you can sell, then you're making money. That's kind of the best inventory to have. Yes. So there's a lot of people that will go and talk to their tax accountant or their CPA. And they'll get advice from their tax accountant or their CPA. And then they come on Whatnot and they do chat shows, or they're in their show and they're just talking. And they're like, oh, well, I travel to this other country and I can write all this travel off every time I go because I source over there. That may not be true. Maybe that might be true in your situation. Don't give advice when that advice was given to you. That advice was given based on your unique set of circumstances. It doesn't mean that it's going to apply to everybody. So be careful, filter the advice that you get, particularly tax advice. I've just heard so much bad tax advice in the last 3 months, and I'll hear it again next year, and it'll annoy me just as much next year as it does this year. And that's part of the reason I do these shows. Anything somebody says about taxes, you can always verify for yourself for free at irs.gov. There is nothing that you cannot verify and fact check for yourself. That explains why you stumble over your words. You only have half a tongue. Yes. So do you get receipts from yard sales, estate sales, or rich sales? Trying to figure out how I would do that. So the best way, Ellen, to do that is keep a logbook. And the IRS will completely 100%, if you're ever audited, totally accept some type of a log book, whether it's electronic or it's an actual pen and paper that you keep in your car. And every time you buy something from one of these types of places, write down the date, what you bought, like the business purpose, vintage inventory, men's clothing, women's clothing. So kind of write what it was. It doesn't have to be a paragraph. A few keywords to know what it is enough. So the date, what it was, how much you spent. And if you're doing this a lot, maybe the area you bought it in, just to kind of give a little credence to it. Also, if you write the area you bought it in, that links back to your mileage and just gives a little more validity to it, because you also have a trip to the east side of town, and then so you have in your mileage log the east side of town, the business purpose, and then in your garage sale, estate sale log, you also have east side of town showing what you bought. If you missed something from last year, can it go into next year? No, Cream City Rollers, it absolutely 100% can never go into the next year. If you missed something big from last year, the best thing for you to do is to file an amended return. So fix it, amend the return and fix it. If it's something little and it's not going to really change your return much, just leave it. Yeah. It's always, when we're looking back at whether we amend or not, one, it's, do I need to amend to meet a law? Am I breaking the law if I don't amend it? So that's an easy yes, right? And then the next qualifier is, how much is it going to either cost me or make me? Like, what's the financial impact here? And is it worth doing the amended return? Now, if it's money back from you, if it's for a refund and you're like, you know what, if I amend this, I'm going to get $10 back, I would probably just be like, so what? It's not worth my time. The IRS will never care if they owe you money. They will never care. Now, if it's something that you need to amend and makes it so you owe them money, then that's a call you need to make as a business owner. If it turns out you owe them $5, I would be like, yeah, what are the odds of that one? I'm probably not going to worry about it. But if it's a significant amount of money, I would amend to do that, because you don't want the IRS coming back, finding it, and then you get penalized for it and you're charged interest and all the extra fees. It's not worth it at that point. But it's really a judgment call. Now, if you filed your extensions, you have till October 15th. Please don't wait till October 15th. Don't do it, because you're already 4.5 months in. Do you want to be 3 months from the end of the year filing a tax return to turn around and have to do it again? It's just not worth it. Get it done. Rip that Band-Aid off. Take the hit. Move on with it. I know October, it's so tempting to be like, oh, October 15th. We can wait. So you guys are very welcome. Thank you for being here and asking questions. If there's any other questions, let me know. I'm going to keep talking for a few more minutes and just to see. I'm really here just to answer questions. I have a few notes just in case to fill up time, but some key points to remember as we move forward now into a new tax year, is if you don't track it, you can't deduct it. So we've talked a lot about the mileage and stuff like that. So if you don't track it, you can't deduct it. To make mine easier, I keep all spreadsheets of all. Perfect. And that's all you need to do. That is perfect. I am actually working on, you guys, to add into my library I am working right now on a very detailed spreadsheet, multiple tabs that will allow you to track income, expenses. I have an income expense one, but it's pretty basic. I'm doing a really good one that has calendars, show planners, income and expenses. It'll do a profit and loss statement for you. So I'm working on something really cool to put into that library. Can you touch on quarter? Sure. So the easiest way to understand quarterly estimated taxes. One of the numbers I told you that you need to keep from your tax return is the line that says total tax liability. That's how much tax you owed. It will be for sale. It'll actually be part of the library, and it'll be a PDF for $5. It's going to be well worth the $5. It's worth probably $30 or $40, but I will sell it for $5. It'll be one of those, and it'll be one of the library. So if you already have access to the library, if you've already purchased it, it'll just be added and you'll just get it. It'll just be there for you. You won't have to buy anything more. So for the library that I have, once you buy it, anything I add, you have access to moving on in the future. So it's just a one-time price. Yes, the spreadsheets. I also add a link to the digital receipt in case. There you go. That is really smart. Now you are organized. Okay, so the tax liability line. You need to know that from your tax return. That was one of the ones I'm saying. Before you guys forget about your tax return, go take a look at that tax liability line. It's not your refund. It's not what you owe. It's a few lines on top of that, and it literally says tax liability. That's the amount of tax ultimately that you owed the IRS. Then underneath that line, it has the section for all the taxes you paid in. Then you get to your refund or amount due. That tax liability line. Why is that important? As we're moving forward, your estimated taxes, the IRS says, if you expect your tax liability to be $1,000 or more than what it was last year, then you need to pay us estimated taxes. Okay? The IRS is a pay-as-you-go system. So how do you know if it's $1,000 or more? Well, one, you need to know what that number was. What's our starting point? Then you need to be able to look at your revenue, look at your expenses to figure out where you are at a net profit. Okay, so we've already gone through the first quarter. January, February, and March is done, right? The estimated tax payment was due in April for that. Let's just say, let's not get all caught up on dates here, but let's look at the first quarter, the first 3 months of the year. What you should do is take a look at those first 3 months and figure out what your net profit is. Let's say your net profit was $1,000, that you actually ended up making $1,000 after all is said and done for the first 3 months of this year. That's your profit. That's not what your tax is. So you need to go back to your tax return. You need to look at your total tax liability, divide that by your total income, so you get a somewhat of a ratio of what percentage in tax you're paying. So let's just say that works out to be 15%. You're paying about 15% in tax. Now we know about how much tax you paid. We know that for the first quarter, you had $1,000 of net income. So I'm going to take 15% times that $1,000 for my net income. What is 15% of $1,000? It's $150, right? So, okay, I know that I need to pay estimated taxes if my liability is going to exceed $1,000 or more. For the first quarter, right now, my liability is $150. I'm in the clear. I don't need to worry about estimated taxes. Then I go to the second quarter and I do that same exercise as I get close to the second quarter. And I figure out all the way from January to the end of June, what is my tax liability? Is it $1,000 or greater than what it was last year? If it's a no, don't worry about estimated taxes. If it's a yes, then you need to pay whatever you think it is. It's estimated. They're called estimated taxes. It's not going to be an exact number. You're estimating what that tax is based on the type of formula I just told you. That is a very high level formula for you to do some math rough and dirty. If you're using a computer system, it'll get a little more exact to the dollar, but either way is acceptable. Then you get to the third quarter and you do that again. Does that make sense? I hope that makes sense in the way that it's figured out. Now, if you even have an inkling, you're like, my business is booming. I know I'm making hand over foot way more money than last year. I know for a fact without even calculating, I'm going to have taxes this year. If you just know that, okay, because you can tell, I mean, one, you should be keeping your books, but I'm just going with it here just in case you're not keeping books. You're doing 5 shows a week, you're making thousands of dollars, where last year you were doing 1 show a week making hundreds, right? If you just know, S corps are 100% different. 100% different. Everything I'm talking about is aimed at a sole proprietor or a single member LLC. So an S corp, you're not paying estimated taxes in. It is a pass-through entity. So an S corp is what's considered a pass-through entity. An S corp is actually, you're probably either an LLC with an S election or you're a C corp with an S election. So the S is just a tax classification. It's not a legal entity. It's attached to a legal entity, an LLC with an S. Yep. So the S corp turns that into a pass-through entity where you're going to be paying an actual payroll to yourself and anybody else that's part of that S corp. So you should be paying yourself a payroll. Usually S corps make sense when you get to the point where you're paying 40 or 50,000 in profit. That's where it starts to make sense to have an S corp. There's a lot of other factors. That is just a very loose general rule. And so you're paying payroll. That's how you're paying into the federal your taxes through a payroll. And then the S corp issues you what's called a K1. That K1 goes on your tax return. You don't even file a Schedule C as an S corp, because everything flows through on a K1, which goes on various parts of your return based on the income type. A lot more in depth, a lot higher level than kind of what we're talking about. However, what does stay the same for an S corp is most of everything else that's deductible. All these business expenses, all these other concepts we're talking about stays the same for an S corp. But estimated taxes are one of those things that are completely different. You're not paying yourself yet and you already have an S corp? Interesting. So an S corp, one of the rules of an S corp is that within a certain time period, you do have to take a reasonable salary. That is a qualification of an S corp. So only 6, and you did an S corp within 6 months? That's a little fast, but again, I do not know all of your facts and circumstances. If that's what your CPA advised, after knowing what all of your facts and circumstances, you go for what they advised you. I'm just surprised, but again, if I do know all of the information, I could have a different opinion. And this is a perfect example, you guys, of why when somebody on Whatnot says something about taxes, you can't just take it for your own use, because like Cream City, I'm going to answer you. Black Lab Candles here. I'm like, as a CPA, I'm questioning, okay, well, that seems a little odd to me, but they have their unique set of circumstances. So it may make total sense to them, but not be applicable to somebody else. All right, when should you get an LLC? So there is not a time that I can tell you exactly when, and it is not absolutely needed in every case. I operate just fine as a sole proprietor. For an LLC, there are a whole bunch of different variables that you would need to consider. And if a lot of those variables are yes, then it probably makes sense to get an LLC. If their answer to most of those are no, then it doesn't make sense. Some of the variables that you would consider, and this isn't an all-inclusive list, this is just off the top of my head what some of these variables are. Do you currently have or do you want to have partners? What are your current financials now? What do your projected financials look like? What type of assets do you own personally? What type of assets do you own in the business? What type of assets do you plan to own in the business? Do you have employees? What are you doing in your business? Is it a highly litigated type of business? What type of liability do you have? Those are kind of like the key things. There's a lot of other questions. Those are kind of the key things that you start to think about before getting an LLC. Yep. Okay. Well, good. Hopefully that helps. Only done it due to liabilities and candle making. So see, and again, it goes back to your unique set of circumstances. LLCs, S corps, there's not a one size fits all solution for everybody. All of us, even though the tax law is the tax law, right? There's one United States tax law, that is it. but all of us are so different that our tax return and our tax situations are extremely different. We can all, everybody in this room here, all 23 of us can compare our tax returns and they would all look very, very different, even using the same tax code. Because it depends. Are you married? Are you not married? Are you widowed? Do you have kids? Do you have kids in college? Do you own a home? What kind of business? I can go on all day about all the variables that would go into your tax return. That's why it looks different for each of us. Are you disabled? Are you not disabled? Do you have Social Security? Do you have passive income? Do you have active income? Like there's all these different things that make us all look so different. And done an S Corp because myself and husband are partners. So it does look different when you have a husband and a wife as partners. So it does, yes, that is a consideration, absolutely. So a lot of times when people end up going into business, like for our situation, me and my husband are both in business, but I file as a sole proprietor under me individually. So it goes on our joint tax return, but I am the business owner here. Now, if we were to form an LLC and we were both listed as partners on the LLC, then we cease to be a single member LLC. And then it looks different. And it's a different application of the rules. And I know that's kind of getting deep into it. It's a lot more than most people face. A lot of people on Whatnot are sole proprietors, and you don't have to worry about all the legalities of S Corps and LLCs. But as you grow, that's usually kind of like a growth thing. You start as a sole proprietor, possibly become an LLC, and then there's certain times when an S Corp makes sense for tax reasons. So it's kind of like a growth measure. This is why I say you should have a CPA and CPA or a tax advisor and probably an attorney that you can consult with. It's vital when you're looking at growth. And your first year. I highly recommend your very first year in business to at least have a consult with some type of a tax professional, because there's decisions you have to make that will affect future years. I fired my husband. I know, me too. And he keeps showing up. I keep looking over and there he is in my shows all the time.
Miss Liz, you heard that, right? That means I have permission to leave.
He can't leave. He's going to be here forever. He knew what he got when he was marrying me.
You are all my witnesses now.
Y'all, I tricked my husband into marrying me now. Kind of. Side note, you guys want to hear a personal story? You want a little side note away from taxes? He's like, don't tell the story. We met, and we were only dating about 3 months, and he got deployed. And we were living about an hour away from each other. And so he got deployed. This is right at the pandemic. No, it doesn't involve rope and handcuffs. That was the first story. That was the first day we met. This is about 3 months in. And so, I mean, we're two grown adults. We have both been married before. So we're, a little bit older adults.
Oh, Mama. So many different stories.
And he got deployed. And I said, I'll tell you what, I've been spending weekends up here. Why don't I come up and just, gather your mail and check on your house every now and then. And at the same time, and he's like, yeah, that's really nice of you. Thank you so much. Well, at the same time, I had put my house up for sale because I had recently gone through a divorce and I needed to sell the house. So my house was up for sale, but we had just started COVID. All of this just broke out in the world. So I'm like, my house is going to sit on the market forever. Besides which, it was a very unique house for the neighborhood. So I'm like, it's going to take forever to sell my house. Well, lo and behold, my house sold within 60 days. And myself and my daughter, 9-year-old daughter at the time, were like, where do we go? So I went to my then boyfriend's house and I called him up. I said, my house sold. So guess what? He came back and he was no longer a bachelor. We had moved all our stuff in, and that's the end of the story. Been together ever since. He came home to a completely redecorated, sorry, that just was loud. I just hit the microphone. Redecorated home, and all his bachelor stuff was gone. We had nice, pretty girly stuff. And that was the rest of the story. So, but it worked out. All right, back to tax. If you guys, any more tax questions, if not, we're going to go ahead and and go find somebody to raid. And if you guys have any more tax questions, I am always available. Send me a DM. Right now, I get a DM maybe once a week. As long as it's not like excessive, I'm going to keep opening my doors to DMs, and I will be happy to answer questions. If it ever gets to be too much, I'll have to set up hours or of some sort. Yeah, a whole new meeting to Honey I'm Home. Completely new meeting, yes. So.
And now she sells my things without even telling me.
I did, you guys. I sold a box. Mama, I think you were in the show this morning. So I had this little box and I had it listed in my stuff. I had it listed in my shop, and my husband saw the box and he's like, "Oh, this is really cool. I'm going to keep it." And then I forgot to take it out of my bin, and it sold on the show the other day. So I went to pack it and I had to go find it and empty his stuff out and pack it up. And then I put his stuff in a plastic bag, and he sat down at his little computer station and he's like, "What's this bag? Where's my box?" And I'm like, "Sorry, I sold it." So, but all right, you guys, you have a great weekend. Tomorrow morning, I have a reverse auction at 8 a.m. If you've never seen a reverse auction, come check it out. Even if you don't have money to spend, come check it out. They're totally cool. They're fun. It's going to be about an hour show, so it's not super long, 8 o'clock Eastern. We'll see you then. Have a good weekend, you guys. Let's go see who's on. I do not know who's on. We got to go to Southern Charm. There's no question about it. She's doing vintage decor. She's super sweet. Put some ducks in the chat when you see her.
So good weekend.